Welcome, everyone, to the Washington Financial Group Fiduciary Fitness podcast series. My name is Colin Clark, Senior Vice President of Retirement at Washington Financial Group Hub Mid-Atlantic. And again, I'm joined by Jennifer Amato, who's the Director, CPA at SC&H out of Baltimore, Maryland. We're very excited to have Jennifer with us. Welcome again.
Thanks, Colin.
So kind of in concluding our series, we've talked a lot about how to ensure, a better audit process. We've talked about the CARES Act. And one thing that you and I talk about frequently when we're doing workshops and working with plan sponsors is, we talk a lot about what are the top issues that you find in audits and how to help plan sponsors kind of get ahead of that. So what are the things you're seeing that happen quite often?
Sure. So I would say one of the main issues we've been seeing recently is, and I shouldn't say recently, it's been for a while now, is definition of compensation. And that really depends upon the type of organization and the types of pay that an organization may have, how complex their payroll is. As you know, the plan document governs what the definition of compensation is. Obviously, there's allowable compensation, there's 415 compensation and things like that. Within most plan documents, there are ways to carve out or include certain types of special compensation, if you will. Those types of compensation could be differential pay, bonuses, stipends. They're probably the main ones that we typically see. And then obviously, are you adopting 3401 type compensation, which is basically income tax compensation, or just gross W-2 wages compensation? Basically just what does your plan document say? And then just like we had spoken about in some other podcasts, is really knowing your employee base and knowing your payroll system, basically. And what we see a lot of times is that the plan may have the best intention of following their payroll, their definition within payroll, and excluding certain things or including certain things. However, when push comes to shove and payroll is programmed, if you will, sometimes things do not get put in the right category. A lot of times we see this fail when new pay codes are added, because pay codes may not be added properly or excluded properly from 401k eligible compensation to calculate deferrals on. So in a very vanilla company where basically all compensation is included and there are no exclusions, this might not be that much of an issue. When you start getting into a little more complex of organizations, or organizations that have at least different types of compensation, like if they have people paid on commissions, if they have people that get bonuses quarterly, if they have, stipends, a lot of times with, not-for-profits with 403B plans and these stipends, they're factored into compensation. That's when it gets a little more hairy. And the reason for a definition of compensation being such an important issue or important point is that is, as I mentioned, how deferrals are calculated. So you could run the risk of either too much being deferred upon or not enough being deferred if the definition of compensation isn't set up properly. And then following through from that, obviously there's the employer contribution that is based upon that. It's based upon deferral a lot of times. So you could either over-contribute or under-contribute your matching contribution to employees, and even a profit sharing if you're doing some sort of non-discretionary or discretionary profit sharing or some sort of other employer contribution as well. You could still be over or under-contributing to employees, which, again, is not in accordance with the plan document and definitely something that needs to be rectified.
Yeah, that's actually a really good point, because I feel like I've been asked this question a lot recently about bonuses, and should bonuses be included? Do you opt in? Do you opt out? I think the trickier parts are some of the 409A compensation pieces and making sure we exclude those things. I mean, how do you feel about bonuses in 409A?
Yeah, so especially with the bonuses, I think it again goes back to understanding your workforce as well. Because obviously you potentially have, if you're not a safe harbor plan, obviously non-discrimination rules to deal with too. So again, some plans may elect not to allow folks to defer on bonuses because that could be more of your highly compensated folks, and that might put the plan out of balance when it comes to year-end testing. Some of our plans allow, as you mentioned, for an opt-in, opt-out. So there is a separate election that they can, typically you're opting in for everything, but you can opt out for bonuses if you so choose to separately. So really, again, I know I keep saying know your employees, know your industry, things like that. But I think a lot of this really depends upon that. And if you know how your employees contribute, what your makeup is between HCEs and non-HCEs, whether obviously you're a non-safe harbor or a safe harbor plan, things like that, that can really help you make your decision as to what you exclude or include in your definition of compensation.
So, no, that's great. Thank you for that. What would you say is like another top issue that you've been seeing recently?
So another top issue that I would say, and it encompasses a lot of things actually, is where we see issues come up a lot is when plans change their plan documents. That might be because they change vendors and they might change from one prototype plan to another prototype plan. They might change from a prototype to individually designed or vice versa. And obviously, as you know well, Colin, every prototype plan, every volume submitter plan is written a little differently. Obviously, they, at the end of the day, need to get you to the same place, but they may have their checkboxes differently. If it's a prototype plan, they may have their language a little different in their volume submitter. And what you might assume is written the same way and means the same thing that it did in your current plan might mean something different in another plan just because of the way it's written. Or you might just check the wrong checkbox. A lot of times one of the big issues that we see is the contribution period for employer contributions. So, in your current plan document, you've always been contributing and calculating your batch on a per payroll basis, which would not require a potential true up at the end of the year. But for profit sharing, obviously you always did that on an annual basis, and you had those things checked differently in your current plan document. And then your new plan document might just have one blanket section that says, for all employer contributions, they are going to be calculated annual per payroll. And you might check annual because obviously you want your profit sharing check on annually because you're going to contribute it annually. And that might throw you into a situation where, I never really intended for my match to be annual, but now it is because I either checked the wrong box or it meant something different. And that's a very egregious example where, I don't know that there's many plan documents that are written that way where you can select only one contribution period, but that's kind of a type of thing. It might just be checking the wrong box in the wrong section. I thought I was checking that for profit sharing and I checked it for match.
Yeah, no, we actually had a client. This exact issue happened with them. They signed off, they sent the record keeper the plan document the way they want it written, and someone, made a mistake. And boom, you're operating the plan incorrectly. And we had to do a self-correction because the record keeper made a mistake in processing the correct plan document setup. And the client wanted to operate the plan like they always have. And it got misinterpreted at some level, and we had to catch it. And so we fortunately caught it, and had to go through a self-correction. But it was really unfortunate. I mean, people are human and they make mistakes.
Sure.
But, even though a lot of eyes and a lot of people saw that document, it's still, once you kind of send it out, the wrong boxes were checked. It's crazy.
Right. Yeah. So I think the key there is, like you said, everyone's human, and just make sure that, you're doing that double check. I know I tell people all the time, I know that you think, to your point, that you sent what you wanted to your record keeper and they checked the boxes, but how much time does it take to do a quick double check when you get that draft document before you sign it? And it could save you a lot of headaches and potentially a lot of money, depending on what the correction needs to be to bring everything into compliance.
Well, that's a great point. And I think a lot of people don't realize that their retirement plan is actually a big, liability. I mean, of course, we're, at Hub International, we're in the risk business, right? We're mitigating risk at all times. And I sometimes I don't feel like people appreciate the amount of risk that exists in a retirement plan until something happens, which, we want to be that beacon, that lighthouse, and show people, hey, let's not get it to the point where Jen and SC&H are catching issues, right? We want to be very proactive,
right,
and have preventative measures, not reactionary measure. So that's how we work as a team, as professionals with our clients. That's why this podcast has been great, because we're really, getting people to think about, the different issues that they want to be cognizant of as they're managing their plans. So
absolutely.
Jen, this has been great. Thank you for this great podcast series. And
no problem. Thank you for having me.
Yeah, we want to thank everyone for listening, and we'll see you next time on the Washington Financial Group Fiduciary Fitness podcast series. Thanks, Jen.
Thank you.
That's going to do it for this week's show. Thanks for listening. If you enjoy our show, we'd love for you to subscribe on iTunes or wherever you access your podcasts. The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA, and SIPC. Investment advice offered through Global Retirement Partners, LLC, a registered investment advisor. Global Retirement Partners, Washington Financial Group, a division of Hub International Mid-Atlantic, and Hub International are not affiliated with LPL Financial. Global Retirement Partners, LPL Financial, Washington Financial Group, and Hub International are not affiliated in any way with the services offered by any guest on this show.